$730 billion. That's how much US Treasury debt China held in July 2025, the lowest level since February 2009, down $25.7 billion in a single month, the steepest reduction in nearly 2 years. But that's not the story. The story is what China is buying instead. Gold, 2,303.5 tons as of September 2025, 11 consecutive months of additions, and silver, undisclosed amounts through refining monopolies and export restrictions that just locked up 60 to 70% of global supply. We've seen this movie before. Act 3 of a 4-act play where empires don't collapse from military defeat. They collapse from monetary restructuring, from liquidity crises, from the moment a major power decides paper promises aren't worth holding anymore. Rome did it with silver debasement. Britain did it when the pound lost reserve status. And right now, China is doing it with surgical precision. They're not attacking the dollar. They're simply walking away. And Wall Street has no idea what's coming. Let's start at the beginning. 56 AD, Rome. Emperor Nero faces a problem every empire eventually confronts. The treasury is bleeding. Military campaigns cost more than tax revenues can cover. Infrastructure projects demand funding. The bureaucracy grows expensive and the bills are coming due. Nero had inherited a currency system built on trust. The denarius, Rome's silver coin, was supposed to be 90% pure silver. That purity represented Roman power, Roman credibility. When you held a denarius, you held the empire's promise. But promises are expensive to keep when you're running deficits. So Nero did what seemed reasonable at the time. He adjusted the silver content, dropped it from 90% to 85%, just 5%. Who would notice? The coin still looked the same, still spent the same, and suddenly Rome could mint 20% more coins from the same amount of silver. It worked. For a while. His successors saw the same playbook. Why stop at 85%? Septimius Severus dropped it to 50%. Caracalla went to 30%. By 270 AD, the denarius was 5% silver, 95% copper with a silver wash. The Romans called it monetary engineering. They had economists. They had advisors. They understood what was happening. They did it anyway because there was no other choice. The debt had them trapped. And what happened? By 301 AD, Emperor Diocletian had to issue price controls because inflation was catastrophic. Workers demanded payment twice daily because by afternoon their morning wages couldn't buy bread. The wealthy Romans who saw it coming didn't trust the debased coins. They hoarded pure silver. They melted down old coins and stored bullion. Because when paper promises fail, when governments debase their currency, humanity always returns to the same solution. Physical assets, tangible value. Things you can hold that governments can't print more of. That's Act 1. The borrowing phase leads to the debasement phase, the pattern that's been repeating for 2,000 years. Fast forward to 1944. Bretton Woods, New Hampshire. World War II is ending. The global monetary system is in ruins. European currencies are worthless. Asian economies are shattered. And the United States holds 70% of the world's monetary gold, 20,000 tons, more than everyone else combined. So the Allies gather and create a new system, the Bretton Woods Agreement. Every major currency would be fixed to the US dollar, and the dollar would be fixed to gold at $35 per ounce. The US Treasury promised that any foreign central bank could exchange dollars for gold at that rate. Anytime. No questions. It was brilliant. The dollar became the global reserve currency, not because of military power, though America had that, but because of a promise. A gold promise. Hold dollars and you're holding gold. For 20 years, it worked. America exported dollars. Foreign central banks accumulated them. International trade flowed smoothly. The dollar was as good as gold because it was backed by gold. But here's the problem with promises. They're expensive to keep when you're running deficits. Vietnam War, Great Society programs, rising government spending. America was printing more dollars than it had gold to back them. By 1971, the math wasn't working anymore. Foreign central banks started getting nervous. France sent warships to New York Harbor to collect gold. Others quietly converted dollars to gold. The U.S. gold reserves started draining. August 15, 1971, President Nixon goes on television. The gold window is closing. Temporarily, he said. Just temporary. Dollars would no longer be convertible to gold. It was never reopened. The dollar became a pure fiat currency. No gold backing, no tangible asset, just a promise. Trust us, America said. The dollar is valuable because we say it's valuable, and for 50 years, the world accepted that promise. Because there was no alternative. Because America was the largest economy. Because the petrodollar system forced oil purchases in dollars. Because treasury markets were deep and liquid. The dollar's reserve status became self-reinforcing. Countries needed dollars to buy oil, to trade internationally, to hold as reserves. So they bought treasury bonds, which funded America's deficits. which allowed America to keep printing dollars, which the world kept accepting. A beautiful system, as long as everyone keeps playing. But what happens when the largest players start walking away? That's Act 2, the external pressure that reveals the system's fragility. Now let's talk about today, December 20, 2025. According to the US Treasury Department, China cut its US Treasury holdings by $25.7 billion in July 2025, down to $730.7 billion, the lowest level since February 2009. That's 16 years. And it's not just July, it's a pattern, a deliberate, sustained reduction. Foreign official institutions as a whole were net sellers of U.S. securities in October 2025, $19.2 billion in net official outflows. This isn't panic selling, it's strategic repositioning. And here's what Wall Street isn't discussing. Where's that money going? Gold. China added 15 tons of gold in September 2025 alone, 11 consecutive months of purchases. Official reserves now at 2,303.5 tons. But analysts believe the real number is much higher, maybe 3,000 tons, maybe 4,000, because China buys through multiple channels. State enterprises, sovereign wealth funds, the Shanghai Gold Exchange. Not all of it shows up in official statistics. Goldman Sachs projects. China needs to acquire 40 tons per month for 3 years to bring its gold to reserves ratio in line with global averages. They're on pace, and they're not stopping. But gold isn't the only story. Silver. China holds roughly 70,000 metric tons of silver reserves in the ground. They produce 3,400 metric tons annually, 110 million ounces, world's second largest producer. But more importantly, they control refining. 60 to 70% of global refined silver flows through Chinese facilities. And on January 1st, 2026, 11 days from now, China will restrict silver exports. Only large state-certified companies producing at least 80 tons annually get licenses. Small and medium exporters are locked out. The supply valve to Western markets is about to close. This isn't random. This is coordinated. Treasury sales, gold accumulation, silver export restrictions, all happening simultaneously, all pointing in the same direction. China is restructuring its reserves away from dollar paper and into physical assets. Remember that Bretton Woods promise? Gold backing at $35 per ounce? The US broke that promise in 1971 because deficits made it impossible to keep. China watched, China learned, and now China is making sure they're not holding paper when the next monetary restructuring happens. Because here's the pattern. When debt becomes mathematically unmanageable, when deficits spiral out of control, governments face three choices. Default, political suicide. Austerity is also political suicide, or debase the currency, slow suicide, but you stay in power longer. America chose door number 3 in 1971, closed the gold window, went full fiat. And for 50 years, yes, it worked because dollar demand was structurally embedded in the global system, but structural demand can be restructured. Let's zoom out. Let's see what's really happening beneath the surface. The Institute of International Finance reports global debt hit $318 trillion in 2024. Debt to GDP radius owe 328%. We owe more than 3 times what the planet produces annually. For the first time in 4 years, that ratio increased. U.S. federal debt alone exceeds $34 trillion. Interest payments now consume 15 to 20% of tax revenues. That money isn't building infrastructure. It's servicing debt on money already borrowed. The debt trap, where you borrow not to invest, but to pay interest on previous borrowing. Act 1 complete. We borrowed to expand. Act 2 in progress. The debt is becoming unmanageable. And now Act 3, the debasement phase, the moment when paper currencies come under stress and smart money moves to tangible assets. Here's what makes this different from previous cycles. In previous cycles, America had liquidity dominance. When stress hit the system, everyone fled to dollars and treasuries. Flight to safety, flight to liquidity. It was automatic. But in April 2025, something broke. For the first time in modern history, during a market stress event, treasuries and the dollar moved in opposite directions. Typically, they move together. Risk off means both strengthen. But in April, we saw the dollar weaken while treasury yields rose. Decoupling. JP Morgan called it a trifecta that's only happened 13 times since 1970, and 2025 is the first time since 1981. Think about what that means. The traditional relationship between treasury safety and dollar strength just fractured. The automatic bid disappeared. Treasury market liquidity in April 2025 worsened to levels not seen since March 2023. Order book depth, the amount of securities available at best bid and offer prices, plunged. Why? Because the marginal buyers are stepping back. Foreign official institutions are reducing holdings. China is cutting treasury positions. Others are diversifying away. And when the marginal buyer disappears, liquidity dries up. Remember Rome? When the denarius was 95% copper, who wanted it? Remember Bretton Woods? When dollars exceeded gold backing, who converted first? The smart money. The people who see the pattern, who understand that when monetary systems come under stress, paper promises lose value, and tangible assets preserve wealth. And right now, China is the smart money. They're not attacking the dollar. They're not trying to crash treasury markets. They're simply repositioning, reducing dollar exposure, building physical reserves, gold, silver, critical materials, things that hold value regardless of which paper currency is dominant. The Treasury Department's own data shows this clearly. Net foreign official outflows in August, September, and October 2025. Not inflows, outflows. The traditional recycling of trade surpluses into treasuries, it's slowing. China specifically mentioned in reports that the reduction reflects foreign exchange reserve diversification as U.S. government debt exceeds $34 trillion, and market concerns over repayment capacity rise. That's diplomatic language for we're worried about your ability to pay this back. And they have reason to worry, because the math doesn't work anymore. The U.S. needs to roll over approximately $7 trillion in treasury debt annually, maturing bonds that have to be refinanced. If foreign central banks aren't buying, who fills the gap? The Federal Reserve, which means printing money, which means more currency debasement, which validates China's decision to move into physical assets. It's a self-reinforcing cycle. The more China reduces treasury holdings, the more pressure on treasury markets. The more pressure on treasury markets, the more the Fed has to step in. The more the Fed steps in, the more currency debasement. The more currency debasement, the more other countries follow China's lead. This is how reserve currencies die, not with a bang, with a slow migration, a gradual shift. Until one day, the system realizes the marginal buyer is gone and liquidity evaporates. Now let's talk about silver specifically, because silver sits at a unique intersection in this story. Silver hit $67.30 this week, up 130% in 2025, strongest annual performance since 1979. But the price is only part of the story. What's happening in physical markets reveals the real stress. COMEX, the major commodity exchange in New York, saw 47.6 million ounces of silver claimed for physical delivery in early December. 4 trading days. That's 60% of COMEX's registered inventory. Gone, claimed, converted from paper contracts to physical metal. COMEX inventory RS down 73% since 2020. The warehouses are draining, and lease rates, what it costs to borrow silver, spiked to 9% in London. Normal is 0.5%. 9% means someone desperately needs physical metal and can't source it. The silver futures market went into backwardation, spot price exceeding futures price. That only happens when people want silver now more than promises of silver later. It signals genuine physical tightness. And on the supply side, Silver Institute projects a 95 million ounce deficit in 2025, 5th consecutive year. Cumulative shortfall since 2021, 820 million ounces. Imagine draining an Olympic swimming pool every year for 5 years. That's above ground silver inventories disappearing. Meanwhile, demand accelerates everywhere. Solar panels consume 200 million ounces in 2024. Electric vehicle, S90 million ounces. AI data center RS adding demand. And investment demand, people buying physical silver as monetary insurance, is surging. Supply can't respond quickly. 70% of silver comes as a byproduct of copper, zinc, and gold mining. If those operations slow, silver supply drops regardless of price. My output grew just 1% this year. New projects forecast to add only 44 million ounces over the next 5 to 10 years. Rigid supply, exploding demand, vanishing inventories, and now China closes the export valve. 60 to 70% of refining capacity is about to be restricted. This is the same pattern we saw with rare earth elements. China controls 90% of rare earth production. They used export restrictions as geopolitical leverage. Prices spiked. Western countries scrambled to develop alternative sources. It took years. Silver is the next rare earth element, critical for technology, essential for green energy transition. No viable substitutes at scale. China just weaponized it. But here's the deeper pattern. China isn't just controlling silver supply. They're accumulating it. Undisclosed amounts through state enterprises and refineries. Building strategic reserves while restricting exports. Same playbook as gold. Accumulate the physical asset, control the supply, position for the next monetary system, because that's what this is really about. The next monetary system. Let me show you the full pattern. The 4 acts that repeat through history. Act 1, the borrowing phase. Every empire, every monetary system starts here. Borrow to expand, borrow to grow. The debt is manageable at first because growth covers interest. Rome did this, Britain did this, America did this after World War II. Bretton Woods worked beautifully when America's economy was growing faster than its debt. Act 2, the trap closes. Eventually, the debt grows faster than the economy. Interest payments consume more revenue. You're no longer borrowing to invest. You're borrowing to service previous debt. The math stops working. Rome hit this when military costs exceeded tax revenues. Britain hit this after World War I and World War II. America is hitting it now with $34 trillion in debt and rising interest expenses. Act 3, the debasement and restructuring. When debt becomes mathematically impossible to repay, governments choose inflation over default. Nero clipped silver from coins. Nixon closed the gold window. Today, we call it quantitative easing, expanding the balance sheet, and accommodative monetary policy. It's the same thing, debasement. And here's the pattern within the pattern. When paper currencies come under pressure, when debasement accelerates, smart money moves to tangible assets. In Rome, pure silver and gold. In the 1930s, gold. In the 1970s, after Nixon closed the gold window, precious metals. Gold went from $35 in 1971 to $850 in 1980. Silver went from $1.50 to $50, both over 40 times. Today, Chine moving into gold and silver. Others will follow. Central banks globally bought 1,037 tons of gold in 2023, highest in 50 years. They're not buying because gold yields returns. They're buying because gold is money, real money, the kind that survives monetary system transitions. Act 4, the reset. This is where we're headed. When the old monetary system breaks and gets replaced with something new, sometimes it's a new gold standard. Sometimes it's a new reserve currency. Sometimes it's a basket of currencies or commodities. But the transition between Act 3 and Act 4, that's when precious metals perform their historical role. Wealth preservation across the chaos. We're not in Act 4 yet, but we can see it forming. BRICS nations are discussing alternatives to dollar dominance. China, Russia, and Iran are settling oil trades in yuan and rubles. The Shanghai Gold Exchange is expanding internationally. China is building gold vaults in Hong Kong, Saudi Arabia, Brazil, and Mexico, creating a physical gold trading network outside Western control. These aren't random events. These are foundation blocks for the next system. And China is making sure that when that system arrives, they're holding tangible assets, not paper promises. So what does this mean practically? The Bretton Woods system lasted 27 years, 1944 to 1971. The pure fiat dollar system has lasted 54 years, 1971 to 2025, twice as long. And the cracks are showing. China is cutting treasuries to 16-year lows, foreign official outflows instead of inflows, treasury market liquidity stress, dollar treasury decoupling during risk events. These are symptoms of a system under pressure. And the response? Gold accumulation by central banks is at record levels. Silver is hitting $67 with physical markets in backwardation. COMEX inventories are draining. China is restricting exports of critical materials. The pattern says this: when you're in Act 3 and you can see Act 4 forming, you position for the transition. Not because you're panicking, because you understand what comes next. BNP Paribas' $100 silver is possible. Bank of America's technical team is bullish. UBS forecasts $55 by mid-2026. Those forecasts are already outdated. We're at 67, and China closes the export valve in 11 days. But here's what I want you to understand. This isn't about silver going up. This is about what silver represents. Monetary insurance. Protection against the possibility that the dollar's reserve status weakens treasury markets face persistent liquidity stress. That we're in the early stages of Act 4. Think of silver like insurance. You don't buy home insurance hoping your house burns down. You buy it because you understand risk, because if something happens, you want protection. The current price, $67, is high by recent standards. But adjusted for inflation, silver would need to hit $125 just to match its 1980 peak. And unlike 1980, when silver ran on speculation, the Hunt brothers cornering the market, today's driver is structural, industrial demand, supply deficits for 5 consecutive years, monetary uncertainty, geopolitical supply restrictions. That combination creates secular bull markets that last years, not months. Let me bring this back to where we started, $730 billion. China's treasury holdings in July 2025, lowest since 2009. They're not attacking the system, they're repositioning, building reserves in gold and silver, physical assets that can't be frozen, can't be sanctioned, can't be devalued by a central bank printing press. Wall Street isn't prepared for this. Treasury markets assume foreign central banks will keep recycling trade surpluses into dollar assets. That assumption is breaking, slowly, gradually, but breaking. And when that assumption fully breaks, when the marginal buyer decisively steps back, liquidity becomes a problem, not hypothetical, actual. April 2025 gave us a preview. Order book depth is plunging. Yields rise during risk-off events. The traditional haven bid is disappearing. That's not normal. That's systemic stress. That's the early stage of Act 4. History says this. Every time debt reaches levels we're seeing now, every time paper currencies come under this kind of pressure, every time major powers start reducing exposure to the reserve currency, tangible assets preserve wealth. Gold, silver. Physical stores of value that survive monetary system transitions. Rome's wealthy families hoarded pure silver before the collapse. They survived. The Europeans who held gold while currencies collapsed between the world wars, they survived. The investors who bought gold and silver in the 1970s after Nixon closed the gold window, they didn't just survive, they thrived. We're watching the same pattern execute, same acts, different century, different currency, same ending. I can't tell you what to do with your money. I'm not a financial advisor, I'm a pattern recognizer. But I'll leave you with this. China just cut treasuries to 16-year lows. They're accumulating gold at record rates. They're restricting silver exports starting in 11 days. And Wall Street is still operating under the assumption that nothing fundamental has changed. The pattern says otherwise. Act 3. The debasement and restructuring. Act 4, forming on the horizon. The transition between them, that's when awareness matters. That's when understanding the pattern provides an edge. So ask yourself, which act do you think we're in? Can you see the pattern? Drop a comment. Tell me if I am connecting dots that aren't there or if this resonates with what you're observing. And if you want to see what happened the last time a reserve currency lost its status, hit subscribe. Because next week, I'm breaking down the British pound's collapse from reserve dominance in 1914 to secondary status by 1945. The warning signs that appeared years before the crisis. The assets that preserved wealth through the transition. And why the parallels to today are impossible to ignore. The pattern doesn't care if you believe it. It doesn't care about your politics or your economic ideology. It just executes. China is walking away from treasuries. They're moving into physical assets. The question isn't if this matters. The question is what you do with that information. 11 days until the silver export restrictions go live. Wall Street isn't ready. Are you?